All right, we're going to go ahead and get started. So good morning, everyone. Welcome to Maner Costerisan's year-end tax planning webinar. We're so happy that you all could join us today. We're going to be sharing updates on important tax credits and discussing potential opportunities to optimize your tax savings before year end. And a few housekeeping items. This is being recorded. Everyone is muted. And if you have any questions, we are going to do a Q&A at the end. So you can go ahead and put your questions in the Q&A function here, and we will get to those questions at the end. And I would like to welcome Katie Hamilton and Matt Latham to today's session. Katie joined Maner Costerisan as a principal in 2019 and leads the firm's tax department. She is responsible for directing and managing Maner's tax staff, the firm's tax growth strategy, and client service. And Matt was named to Maner's principal group in 2021. He provides tax consulting and support to the firm's affordable housing and small and mid-sized business clients. So thank you both for taking the time to share your knowledge today. Katie, I will go ahead and turn it over to you.
Thank you so much, and welcome everyone. All right, let's get started. Here we go. Okay, real quick agenda for the day. We plan on covering the employer retention tax credits. Just briefly, a couple of things to watch out for that's on the business side. We're going to go over some business and individual hot topics, as well as, of course, planning for 22 and 23. Finish up with some planning around potential legislation, and then we will, as Cheyenne mentioned, leave room for questions at the end. Or if there are questions at the end, we'll cover those. So here we go on employer retention tax credits. So for most of you or any one of you that have been involved from a business perspective, you know that this has been something that's been out there for a while. It's been talked about a lot since 2020, realistically started from the pandemic side of things. The credit is not gone. It has not gone away. And while the eligibility or the eligible quarters may be over, it doesn't mean that you can't go back and amend for this credit. We're going to talk a little bit in a minute about some of the qualifying factors and what the credit means for you. But before we get to that, we just wanted to put out there or warn or remind or make you aware that there are a lot of services that are out there promoting the let us help you get this $26,000 credit per employee. And it sounds almost as if everyone's eligible. And I know that we've had even some of our own clients reach back out and say, you know, I know that we looked before and I wasn't eligible. Can you confirm again? Which is not necessarily a bad thing. But my point is not everyone is eligible. There are requirements to meet that. And just because these businesses are reaching out and offering it doesn't necessarily mean that it absolutely will apply to you. So typically we will see it's kind of our clients are receiving the cold calls and they offer that they will do this on your behalf as long as they get a percentage of the credit. So just something to be aware of or watch out for. We would recommend that in the event that happens to go ahead and reach out to your trusted advisor and let them be the one to make the ultimate decision, likely just because you want to make sure that they're not going to put you in a position where they're claiming a credit for something that you realistically are not eligible for. So with that said, real quickly on the credits themselves. So in 2020, the credit started based on wages that went into effect as of once the COVID pandemic officially, the government shutdown started as of March 13th of 2020. Wages, you could use the wages all the way up for the remainder of the year through 12/31 of 2020. That first year in 2020, the credit was up to 50% of the wages per employee. So you could potentially get a $5,000 credit per employee in 2020, as long as that was half their wages and that you still qualified. You had to take into account the PPP funding. Of course, the IRS doesn't ever want you to double dip. So if you were getting a benefit on the PPP, you couldn't also get a benefit on the ERC, but there were ways around of being able to get both if you use the wages correctly in certain ways. How you qualify for that, as you can see down below, is if there was a governmental shutdown order or even a partial shutdown. So depending on the business itself. So for example, if a restaurant closed but the drive-through was open, if the internal part was still closed down, you still could qualify for that. Credit. Separately, unrelated to the shutdown, and that shutdown could be federal, state, even county, city, as long as it was imposed by the government side of things, a federal or a true governmental shutdown, or that's how you would qualify for part of it. The other piece of it was if you were out of the shutdown, if you were not forced to be shut down for 2020, if your gross receipts were less than 50% of what they would have been in that same quarter that you were looking at back in 2019, then you could qualify. So that was for 2020. When you moved to 2021, the credit actually expanded. So now you're eligible up to 70% of wages, up to 10,000 per employee, but that was per quarter. So it was eligible for wages that were paid from January 1st through September 30th of 2021. Credit ended by the end of September 3rd, or by the end of the third quarter in 2021. So if you had an employee or if you qualified, you could get up to $21,000 for those 3 credits, which is where that $26,000 communication comes from about you can get a $26,000 credit per employee. That would have been the $5,000 in 2020, the $21,000 in 2021. In 2021, in order to qualify, your wages or your gross receipts needed to be 20% less than they would have been in that same respective quarter in 2019. Ultimately, you no longer qualify once your gross receipts are over 80% of what they would have been in that same calendar quarter back in 2019. Just as a heads up, we do still have and are finding that there are certain situations when people are still qualifying for this now and filing for it now. So this is part of why we're bringing it up, even if they maybe previously thought they did not qualify, or we've had a few clients that have come to Maner that had not had this conversation with their former CPA, and us and our employee retention group looking at it, we have determined that they do qualify. So how you get the credit is you file the credit with your 941s. We go back, our group goes back and we do the calculation, determine the amount. You'll file an amended 941 for the quarters that apply, which of course can be whether 20 or, could either be 20, could be 2021, depends on, could be one quarter from one part and one of the other. It just depends on how that, how the gross receipts match up based on that slide previously. And you do have 3 years from the time you filed the forms originally to go back and amend the forms. So we still have time to go back and amend for 2020, as well as, of course, for 2021. That credit is taxable. It's a dollar for dollar reduction in your tax. So it's more beneficial to take the credit. But we just want to make sure that people are aware that the credit itself is taxable, and you are to offset your wage expense in the year you take the credit. So if the credit was a 2021 credit, the credit should be picked up on the 21 tax return, and there may be amended tax returns that are needed if you have since filed your returns and didn't claim the credit at the time. And for individuals that qualify for the 20% reduction related to the 199A, this wage limitation, this will reduce your wages that would be applicable in your wage limitation on the QBID credit as well. So just as a heads up, but still, even with those components, it's still more beneficial to take the credit than pass on it entirely. So that was all. Go ahead.
Next, we're going to cover some business and individual hot topics that we're seeing, especially as we're coming out of some of the CARES Act provisions that are starting to expire, to make sure people know what's going on. The first for C corporations is that there was a brief 25% limit of taxable income during the pandemic. That is reverting back to 10% for 2022 tax years. The good news, though, is that if you are limited in charitable contributions, you can carry those forward. For individuals, most people are aware that with the increase of the standard deduction, it became a lot harder to itemize for a lot of taxpayers, which meant charities or charitable contributions weren't necessarily as advantageous. So Congress put in a brief, what they called a standard contribution, charitable contribution deduction, $300 if you were not filing joint, or $600 if you were. But that has also gone away right now for 2022. So something to think about as you're giving the charities is to look at maybe bunching your contributions so that instead of spreading them out potentially over multiple tax years, especially as we're approaching, the holiday season and year end, is to make, a lot of contributions at once in one tax year to help get you over potentially your standard deductions. That way you can itemize. The second thing that the CARES Act allowed individuals and businesses to do was that if you had a loss in 2018, 19, or 20, you could actually carry that back for 5 years. When the Tax Cuts and Jobs Act got passed under President Trump back in 2000, at the end of 2017, beginning of 2018, the NOLs were actually, NOL carrybacks were actually eliminated, so that you had to carry them forward. Well, because of the pandemic, Congress again brought it back to help people get through, to increase some cash flow. However, you had to actually elect out of carrying it forward. So that way, if you did nothing, technically you're supposed to carry those back. So especially if you have one from 2020 or 2019 where the tax year might still be open, you might need to look at that. There were ways to elect, for example, in 2020 to carry forward your 18 or 19 loss because of the timing of the act. Obviously, most taxpayers didn't elect out in 2018 or 19 if they had it, because the CARES Act didn't exist yet. So they had to put in a provision that on a future tax return, for 2020, if you wanted to elect out, you could elect it on 2020. And then for individuals, the state of Michigan basically followed the federal law. So that way, if you carry back on the federal side, you had to carry back on the state side. Corporations, that did not exist. So those that file under the CIT, under the state of Michigan, you still have to carry forward those losses. Whereas on the federal, you could still carry back. The interesting thing on the C Corp side was that before 2018, the max rate was 35%. So that if you had a loss in 18 or 19, you could take a loss in a lower tax year, because the rate's 21% now, and actually get more taxes back. So it was pretty advantageous for a lot of corporations to do that if you had the opportunity to do that. Next, and right now, this is something that we know are going to impact a lot of taxpayers, especially a lot of manufacturers, a lot of software developers, and even some construction companies. If you do any type of research and experimentation or have any R&D expenses, regardless of whether or not you take the R&D credit, beginning with tax years starting in 2022, you have to capitalize and amortize those over a 5-year period. And if they happen to be foreign expenses, it's actually over a 15-year period. Prior to your 2022 tax years, they were fully deductible and immediately deductible. So this is something that's going to take a little bit of planning right now. This also includes software development costs after 2021. So we know that we have, or that you could have potentially a situation where if you have a lot of R&E expenses, that you could be impacted greatly, and your tax liability is probably going to need to be reviewed for 2022. And doesn't mean estimates necessarily need to change, because if you're protected from the prior year using the prior year exception, then your estimates may not need to change, so you don't get penalized, but you might need to realize that you may have a large tax burden coming. There is some coordination with the R&D credit, in that if the credit is higher than the allowable deduction, then the amount that you capitalize actually gets reduced, so that your future amortization may actually get reduced. You can also elect to reduce the credit if you want to, instead of reducing the amount capitalized. I know a little bit later, we're going to briefly talk about what we think is going to happen down the road. There is actually support in Congress on both sides of the aisle to extend the deductibility of R&E expenses, but nothing's happened. There's a lot of people that I know I've talked to that they really believe that, or they hope might be a better word, that this might change. But unfortunately, without a tax extenders bill, it's not what it is right now. So some planning definitely needs to be done if this impacts you. And then the other thing is, if you have these expenses and you're not taking the R&D credit, then you probably want to start taking the R&D credit, or at least look at maybe even amending prior year returns to get the R&D credit. That way you can help out with some cash flow there too as well. The other somewhat big change, depending on the industry that you're involved in, is the business interest expense limitations. This has been in place since 2018. There is a small business exception that I know a lot of people qualify under. If your gross receipts are under, I think it's 27 million now, using a 3-year rolling average, then this probably doesn't apply to you. But if it's over that, it does. If you're a real estate entity and you haven't elected out of it, then this certainly can apply as well. That basically starting in 2018, you were limited to deducting your interest to 30% of your taxable income. That limit did get raised for 2 years during the pandemic, up to 50%. It is back to 30% for 2022. The other big change was that prior to 22, you actually added back your depreciation expense, any amortization expense, which obviously could be big numbers for some taxpayers. So that way it increased your limit, and then you'd be able to deduct the interest. However, for 2022 and going forward, depreciation and amortization is no longer added back. So that this is definitely something that you need to look at. If it impacts you again, the disallowed interest just carries forward and is deducted potentially in a future year once you generate some income to be able to deduct it. But again, like I already mentioned, there is some small business exceptions. And then if you don't qualify for the small business exception and you're a real estate entity, then you can actually elect out of it. That does impact the depreciation a little bit, but for the most part, we're finding it's more advantageous to elect out if you can as a real estate entity. Next, kind of touching base on the Inflation Reduction Act that was passed earlier this year. The IRS is getting some funding. They're getting about $80 billion for the IRS and related agencies over the next 10 years. The hope or the focus is going to be basically trying to modernize and upgrade the IRS. If anybody has attempted to call the IRS or get a response through a letter in the last 2+ years, you've probably found that it's almost impossible because they were impacted by shutdowns and the pandemic, just like everybody else. They've already hired 4,000 new customer service reps. They're trying to hire another 1,000 more by the end of 22. I know for CPAs that's big because again, these are the people that answer the phones and you're trying to get through. So don't necessarily expect to see an agent outside knocking on your front door, but hopefully, or at least we're hoping that, their internal systems can be upgraded using this money. And then that way, maybe they're a little bit easier to deal with.
Yeah, I know. I was talking to a coworker yesterday, mentioned about the pile of notices. He's just waiting, calls every day, 3 times a day, hoping that one of these calls is going to get through and catch a person to be able to go through all 5 notices at the same time. So fun things. Real quickly on the individual changes here, as part of the Inflation Reduction Act, the premium tax credit was extended, which is the credit that covers individuals that related to health insurance and the subsidies. So that is continuing forward. The energy efficient home improvement credit and residential clean energy credits. Both were extended and revised. You can see the $500 lifetime went up to $1,200 on the energy efficient. On the clean vehicle credit for let's go with the new ones first, with new clean energy credit or clean vehicle credits. On those vehicles, there are more stringent restrictions placed on those clean vehicle credits. And then in 2023, you will be able to claim the previously owned vehicle credit. Again, the restrictions are pretty strong on both of those, are relatively stringent. So I would suggest that don't purchase a vehicle first with the intent thinking that you're going to get the credit. Check first to make sure you get the credit if that's the thing that's driving you to purchase the vehicle. I just know that there are times when people believe they're going to qualify for that credit. And when we dig into it, that might not be the case, just based on certain limitations. And again, if you do plan on buying a used clean vehicle, I would suggest not doing that yet this year, but probably next year once the credit's in place. Go ahead, Matt.
Oops. So next, some of the federal tax changes under the IRA. The Congress decided to effectively implement what we would call an alternative minimum tax back again for C corporations, so that if by chance you have over $1 billion in revenue over the next 3 years, you're charged with tax on 15% of your book income. And then there's some impact for publicly traded corporations on their buybacks as well, where they have to pay 1% excise tax on their stock buybacks. I know for a lot of people probably on this call, though, neither of those things are going to be impacting them. However, we wanted to mention it because I know that at least there was some stuff in the news about a corporate minimum tax coming back. So that's why we wanted to at least mention this. Other business tax changes. The R&D credit was actually expanded for payroll tax purposes for startup businesses. So that for those that don't know, the R&D is actually a non-refundable credit. So you have to have income tax to be able to use it. And if you can, it carries forward. So obviously new businesses, generally speaking, don't make a lot of money up front, or just straight out have losses out of the gate. So that there wasn't necessarily a cash incentive for new businesses. I believe the old limit was $250,000, and now the credit can be up to $500,000 annually for a startup business. And then there are some big green incentives for energy efficient property, as well as basically across the board, you name it. There was a lot of green initiatives under the tax code for alternative fuel, as well as for vehicle credits. Solar panels is another big one that don't specifically have listed here. So that if you add solar panels to your building, I believe if I remember, the credit is up to $2,000 per panel. So that it can be very advantageous. And as far as I know, there's no cap on it. Other than obviously you might have taxable income limitations because these credits are for the most part non-refundable. But again, if they are disallowed, they just carry forward. And then there is also credits, as everybody knows or everybody heard, computer chips were at a shortage with the supply chain, so that there were added credits for investment in semiconductor manufacturing, which is kind of specifically geared towards the computer chips again.
Just real quickly, I wanted to mention on the 1099-K. So for individuals and for businesses, but the question I seem to answer the most question for is, or the people I intend to answer the question most frequently for is for on the individual side. So the 1099-K form is the form that reports the transactions that are reported through a third party, typically through a credit card or whether it be a Venmo or a PayPal. So the thresholds have changed, which is why last year it started and will continue forward, that some individuals all of a sudden received this 1099-K and they didn't know what it was or where it came from. There are requirements if you are in the third party payment network to file that form for anyone that receives more than $600 for payments for goods or services. In an instance when you are transacting with the business and you'll receive the 1099 NEC, which is the non-employee compensation, you may also separately receive a 1099-K depending on how they paid you. And so just watch out if you receive both forms from the same place. It doesn't necessarily mean that all of the income is taxable for both of those forms. At the end of the day, the taxable income that you should be reporting is the amount that from the overall business perspective, not just the forms themselves that you receive. With that being said, I know that on the individual piece, there was language that if you sell things or if you have transactions on Venmo or on PayPal, that you might receive this form. And what we do, and that could be true if you sell things on through those services, as opposed to, I know, if you're just paying someone back and it's through a friend or family or whatever it might be, and it's not for a good or services, those won't qualify and you should not receive a form for that. But if you sell, let's say you sell your old furniture in your house, and through I don't know, you post it on Facebook Marketplace and someone pays you electronically and they mark it as, and it comes through as a good or service, you could receive that form in that case, in that instance from through, from Venmo or PayPal. So just be aware. I know that we've had people all of a sudden, in some instances, the number can be significant and it catches them off guard thinking this is a whole new additional amount of income to pick up. And it's just the proceeds that are payments that have run through that credit card processing or third party payment company.
Next, shifting gears a little bit to some state and local tax issues. A couple big things. Sales and use tax is very much a hot topic right now for businesses, especially in a state like Michigan, where the income tax has been pretty limited on what the state can audit. So that you need to be aware of any sales and use tax issues you might have. You need to be aware, especially if you have out-of-state sales. The Supreme Court, probably about 2 years ago now, 2.5 years ago now, late in 2019, there's a famous case called Wayfair, where basically lowered the threshold from changed the nexus standards from a physical presence standard to basically what I would call a economic standard, depending on the amount of sales or the number of sales that you have. It kind of modernized a little bit the sales and use tax laws that are across the country, especially with online sales. So that if you go over a certain amount, you might be subject to sales tax in that state or use tax, depending on if you bring something in from out of state. Remote employees is another big thing. Obviously, this happened, especially for those that have been located in and around cities. Your business might be located in the cities, but they've been working remotely since the start of the pandemic. Employees can allocate wages outside of the city if they've been working from home this entire time. They don't actually live in the city, even though your business might be operated inside a city limit that has income tax. This does require tracking. It does require a letter from the employer. The cities are pretty strict about it, especially the ones that were around with Lansing and East Lansing, so that these need to be attached to individual returns. And if it's going to be permanent, you might want to have as an employee, or you might want to have a discussion with your employees is, should you adjust withholdings? Should you lower them if they're not going to come back and work in the city? Same thing with remote workers out of state. If you've hired employees in a different state, now you actually have a physical presence in that state. whether or not you have actually any customers. So that may have increased your out-of-state filing. So it's something to be aware of. On the positive side, or something that I actually think is a pretty big positive for individual business owners, is that late last year, the state of Michigan passed what's called the Michigan Flow-Through Entity Tax. And basically, this is a tax that applies to pass-through entities, so S corps, partnerships. It does not apply to single member LLCs. So that if you have a Schedule C or a Schedule E on your personal return, this unfortunately doesn't apply to you. But basically, as a partnership and an S corp, what happened for a lot of business owners is when the standard deduction got raised, one of the other things that Congress did was that an individual, the individual income tax deduction on Schedule A got capped at 10 grand. And anybody that works, has one job, let alone has, you work and your spouse works, plus your home, plus if you have a vacation home, you get capped out pretty quickly at $10,000, even in the Midwest. This was something that the coastal states really kind of kicked and screamed about, obviously with property taxes being so high in those states. So they tried to get creative in how to work around that federal tax law. The first couple of ways they tried, the IRS said, nope, substance over form, you're effectively just doing different types of withholding. But what the IRS did sign off on was that if the state created an income tax for pass-through entities, where basically the state could collect the tax payments, and this is different than the composite filing, because composite filing is specific for out-of-state taxpayers, then the state or the IRS would allow that as a business deduction. So basically, for S corps and partnerships, allowed you to move a Schedule A deduction on your 1040 to page 1. You do have to make, the state was a little clunky in how they added it, because it happened quick. It happened pretty much right before Christmas in 21. And then it created a cash basis problem. So if you're a cash basis taxpayer, you had to make a payment like right away. An accrual basis taxpayer, you had deadlines too to make certain payments. It also created a massive overpayment situation for 21, because a lot of business owners already paid estimates personally. So you kind of had to factor that in, because the business was going to be paying it again. You couldn't apply those payments already. So basically you paid the tax twice in 21. With some planning, hopefully everybody's been able to avoid that for 22, because then the business should just take over the payments that for the tax that it creates. And the first important deadline, if you haven't looked at this yet, is that you need to make a payment by March 15th to be eligible for 2023. It's obviously too late for 21. It's already too late for 22. But if you make a payment by March 15th online to the Michigan Treasury online website, then you can get this potential benefit for at least 2023. The return is initially due March 30th. It's got to be done online. And sorry about that. And the slide deck's jumping around. 1 second. There we go. The forms initially due March 30th. There is generally a 2-week automatic extension to April 15th. But you can actually make, if you do a federal extension, then that will automatically extend the flow through entity tax form or return, because there's actually not a physical form, for 6 months. Everything's got to be done online right now. In some discussions we've had, or we've heard, I should say, the state has kind of considered creating a form for this, an actual physical form, but it hasn't happened. Again, it's one of those things that hasn't happened yet. But for a lot of business owners, the savings can be real. Usually the example I give is that if you have $500,000 in taxable income that flows through to you and you do this, that the savings could be between $7,000 and $8,000 personally, if by making this election. Once you elect, you have to do it for 3 years. And this stays in place as long as the Schedule A cap remains in place, which a lot of people don't realize that cap is set to expire or phase out, I believe, at the end of 25, if I remember correctly. 25 is going to be the last year of it, unless it gets extended. Then come 2026, this flow through entity tax doesn't apply anywhere. You happen to have business out of state, so now individually you have to file out of state. There's something like 21 states right now across the country that have this, so it's something to potentially look at. I know Ohio recently just added it, I think this past summer. So it's definitely something to look at if you have out of state activity as well.
Sorry about the jumping around. I know that was my fault. So I noticed the time too. I know that we want to leave a little bit of time for the specific planning. So I'm going to go through this relatively quickly. I know we've talked a little about the ramping up of the IRS staff and the various notices. So as I mentioned earlier, we still have a very large influx of notices that are coming in from a variety of reasons. And I don't anticipate that's going to slow down much anytime soon. I know the IRS has been trying to address some of the automatic notices that have been pushed out. We still are, there's just still a long backlog. So suggestions would be to make sure that you're keeping track of anything, making your own, documenting things internally, being ready and to communicate that if you are going to handle it on your own, as opposed to your CPA handle it. Again, be upfront and honest with the IRS to the extent, you just want to make sure you're picking your battles as depending on the item. Certainly seek advice as appropriate. You're going to run into issues if you have no documentation. If there isn't anything that is, that you have available to provide where you are coming from, then you will likely run into struggles with them. There are opportunities once you've gone through the first rounds that you can, of course, appeal later, but we don't anticipate this is going to go down. I would suggest that most of the times when we have clients who receive any kind of communication from the IRS, they are in panic mode, regardless of what the notices are. And honestly, it's not necessary. Just the notices a lot of times can be wrong, or we can look through, figure out what the situation is. Could be a timing difference. Most of the time you end up at the end where there are no adjustments at all. And it's just communicating to them that they already have the information on hand and they just need to find it, or here you go, here's the information again. So don't panic. And of course, feel free to reach out. Another item that I want to talk about is in relation to the estate gift and succession planning. So if you've heard me speak about anything in the last couple of years, a lot of it has been around this specifically because of COVID-19 and the pandemic. We've just had, while in general, there is a large influx of individuals retiring just based on the baby boomer population. But in addition to that, even outside of those boundaries, we have individuals that are just ready to be done from a business perspective, because it's been a rough few years and perspectives have changed and any other circumstances. So we've been having a lot of conversations about individuals who either want to retire, they want to sell the business, they want to gift the business. And there really are a lot of planning opportunities. And from depending on the industry you are in, from a market perspective, it might be a great time to do one of those transactions, depending on what your intention is. So from a parent to a child or a relative, sometimes their intent is not to make the child pay them what they would get if they were, if they were to sell it for market value. If it is someone who wants to allow their employees to buy into the company, we find a lot of times that the owners don't want to make their employees pay the same fair market value, depending on the situation. Of course, that's not always the case. And so just the most in tax, we always say that you'll say it depends. So depending on that client situation, there are likely alternatives to get you to the outcome you want. The plan might be one thing, or so you think that's your plan when you have it, when you come up in your mind of what you think this is going to look like, and then you have a conversation with us, and we might end up somewhere completely different. And we're really just trying to make sure you have all the options, that you are aware of the alternatives, that you're taking into account taxes, even though taxes may not be the most important piece of the conversation. It's certainly, at least in this presentation, you're talking to Matt and I, so taxes are important to us, and we want to help you minimize to the extent that you can. Couple of quick reminders: the gifting, exclusion is up to 16,000 in 2022 from 15,000, and in 2023 it will move up to 17,000, and that's what any donor is able to provide to any individual without needing to file a gift tax return, as well as not utilizing that lifetime exemption. The lifetime exemption is currently 12.06 million. And in 2023, it goes to the 12.9 million per person. So a married couple, of course, is just under 26 million in 2023. With that being said, as of 12/31 of 2025, if there is no legislation, the sunset will kick in, and this will the numbers will decrease dramatically back to, I think they're projecting maybe from like back down, I think to about 6 million might have been the amount. So plan frequent, plan often. Don't be afraid when the plans change. Don't try to do it on your own. And be aware that currently the law as it is not going to be what the law will be in just a couple of years. Oh, sorry about that. Real quick. Okay, this one I'm really going to talk about quickly because I know we've had a lot of conversations. So, and I saw that there was just a question about remote employees that I tried to answer. Even at Maner, we are constantly recruiting, whether it be local, out of state. And so just being open to the idea of attracting new talent in a different manner than you maybe had done in the past, open to new areas, to new situations. I know, same thing, I think from a planning perspective, we always say plan, and then plan again. And so just make sure that when you're plotting things out, the things that you need to consider are, our client service and deliverables. Are the delivery times appropriate? If you do have employees that are remote, what does that mean for you? Making sure you're registering for taxes in other states. Does it cause a tax filing requirement in other states? Matt covered some of that earlier as well. But the market is still, at least from our perspective, is still in the employee's hands. And so we are constantly, almost daily, or at least weekly, reevaluating what that means for us from a recruiting perspective, and an onboard as well as a retention perspective.
Okay, next, some planning tips or ideas or things to look out for. Some of this we may have already kind of briefly mentioned. Meals was another one of those things that in the CARES Act got expanded to help out the restaurant industry. That through the pandemic that were initially meals were 50% deductible. The 100% deductibility that occurred in 2021 is still there for 2022. Basically, if the meal is provided by the restaurant, meaning you can't really go into a Meijer and buy, the roasted chicken off the shelf and call that a meal. That would not qualify as 100% deductible. Might still qualify as 50% deductible though. So it's definitely something to think about, entertaining those clients, maybe taking employees out to lunch or bringing in a prepared meal from a restaurant also qualifies to be 100% deductible, at least, for another, about 6 weeks, 5.5 weeks. So it's definitely something to look at taking advantage of. basically just reverts back to 50% starting in 2023. Entertainment is still not deductible. So that if you do anything like golf, sporting events, anything that can qualify as entertainment, golf events is going to be considered entertainment and non-deductible. The big question we get is doing like charitable events over the summer, charitable golf events, or something like that. We generally will recommend that you get an itemized receipt of what it is that you're paying for, especially if they serve a meal, because the golf piece is going to be non-deductible no matter what. But there might be something there that you can actually get as a deduction. Depreciation is another thing that's always been there that is actually going to change right now, barring any action from Congress after this year. 100% bonus depreciation, which has been in place for what feels like forever now, is set to phase down to 80% in 2023. So that if you've been waiting to purchase equipment, get it. Section 179 is still going to be there, but there is a spending cap there, and there is obviously a taxable income limitation for Section 179. I mean, I guess my thought or my opinion is this has always been an extremely popular thing. So that again, if there's a tax extenders bill, we'll just need to see if this gets extended, because that's kind of what's happened in the past, but it just hasn't happened as of yet. So that's why we mentioned it now. It actually goes down to 60% in 24, 40% the year after that, 20% the year after that, down to 0, which I believe gets us out to 2026. Already talked about losses. The one thing I didn't mention before, though, that I want to mention now is that loss carryovers are limited to 80%. So that if you have, say, $100,000 of taxable income, and you have $100,000 loss carryover, you're only going to get $80,000 of it. So that takes a little bit of planning, because you're going to potentially have a tax liability. And then we always encourage looking at some of the Tax Cuts and Jobs Act. The big one was that they raised the limit on certain method of accountings, like cash basis, which for some people was like $1 million under the old threshold. For some others it was 10. Now for everybody it's 27. So that potentially could be cash basis if you're on the accrual method. Inventory does still need to be accounted for, though. Unfortunately, you don't get to just expense inventory straight out.
I'm going to cover a few things. This slide is just for reference, and we've got a couple of slides coming up, but there's a few things that I want to cover just in general on the individual planning side, things that we kind of have touched on and might be slightly referenced in a future slide, but just to make sure that we capture them. We've talked about from a tax planning perspective, and maybe this is what I should do, is just for reference on the increases, significant increases into 2023. Matt, don't be angry with me. I know you covered a lot with the flow through entity tax already. I think most of what you covered is included in here. And so I'm going to skip to our planning component. But just as just about some again, planning perspectives. So we don't anticipate that tax rates are going to go down. So we are generally looking from a planning perspective at what the impact is on 2022 as well as 2023, or multiple years in general. And the intent is always to reduce the entire tax picture, not just for the single year. In general, or it depends, however you want to word that. Most often individuals will benefit from accelerating their write-offs from 23 into 2022 and deferring their taxable income in general, right? So defer taxable income, just instead of paying tax now, pay the tax later. However, be aware that if rates were to increase, that would change things. With that being said, some other things. So we mentioned the bunching strategies on charitable contributions. So making, if from an itemized deduction perspective, which on the slide that you probably didn't notice, but a couple minutes before, the married filing joint itemized deduction limit is now up to 27,700. Which is quite significant. That will be actually, that's the 2023 amount, but from a standard, I'm sorry, that's the standard deduction is what I mean. So you need to get over that amount to be able to benefit from your otherwise itemized deductions. So from a charity perspective, the amount that you need to give before you start receiving a tax benefit is a rather large amount, assuming that you are maximizing your state taxes, and depending on where your interest falls, and then the medical component too. So just from a big picture bunching strategy perspective, since so many individuals are not even eligible to itemize any longer, if you have the ability, or if you're really trying to maximize, bunching is often the best way to do so. So try and bunch as many expenses into a year where you potentially can itemize into 1 year, and then the next year you would not itemize. So if you have the ability, if you're have a very large medical expense year, even if at the end of the year you pay your bills on a credit card, you might not pay the credit card until 2023, but you get the medical expenses then in 2022 to, use towards the limits. Or same from a charitable perspective, really taking the advantage of clumping. I'm going to say clumping instead of bunching things together there. Roth conversions have come up a lot this year. So the market is down, which is a benefit if you're, from a tax perspective, if you're trying to get your Roth IRA over to a regular IRA, you potentially can have more growth in the future. I'm sorry, from an IRA to a Roth IRA, you have more potential growth in the Roth IRA if you move a smaller, lower valued IRA down now, because the market is less, than it can grow in that Roth tax-free environment in the future. So that could be something. Of course, if your tax rates are going to be less in the future, it may not make sense for you, but if you know that in retirement or later on in life, your tax rate is going to be just as high or higher, certainly is something to consider. Also on that, if you qualify for an RMD for the first time in 2022, meaning that you now have to take your RMD, you've turned 72 this year, you have until April 1st of 2023 to take that minimum distribution, but then you would also have to take your 2023 distribution in 2023. So you would have 2 minimum distributions you would have to take in 2023. While that is an opportunity or an option for someone to do, you want to look to see what that will do to your overall tax situation. So if your RMD puts, if that number is large enough that it moves your tax bracket, your rate, all of the things, you might just want to pull that back in and take your distribution before the end of the year. Again, with the market being up and down, if you have the ability to recognize any capital losses, certainly it's never a bad thing to do so. Might not feel that great from a tax market or from a tax or your actual portfolio perspective, but recognizing those losses can benefit you if you have other gains or capital gain distributions, or from an installment sale perspective, if you're able to offset any of that, even if you've sold your home and you are over the thresholds, and so you actually have to pay tax on the sale of your home, recognizing some losses from the market so that you don't have to pay the tax on the sale of the house. All of those are beneficial. Let's see, if you have the ability to defer a bonus, if you have a bonus coming for the end of the year and you could say, hey, can you pay that to me next year as opposed to this year? I don't know if that's an option for anyone. You potentially could do that and delay paying the tax on that bonus for a whole year. On the flip side, if you know that your tax rate situation is higher in the future, pulling that bonus in, or at least a component of that, making sure that you maximize your deferrals. So maximize your 401k, maximize your IRA contributions, your HSA contributions, doing all of that, just in general to reduce your income as much as possible. And the hopes that you long-term are doing the best overall tax picture from a multi-year perspective. All of this will come into play depending on what your unique items are that apply to you, life changes, retirements, business sales, children, all of the items. At the end of the day, every person's situation is different. They're not the same. They are all unique. And we do suggest speaking with your advisor if you have any concerns, questions, just in general, and from a planning perspective to see if there's any of these items that might apply to you so you can benefit from those. You know, I was talking really fast. Matt, do you want to jump in? Oh, you're muted, but
The
that's
only
okay.
thing that I've mentioned before was that we just need to keep an eye out for if there's a tax extenders bill and to extend some of the provisions that are expiring. So that's it.
So with that, I believe if there are any questions, I know there was a question or two, at least one question in the chat I tried to catch and reply to, but if there are any other questions. And then Sydney, I'll let you take it from there, I guess.
All righty. So thank you so much, Katie and Matt, and thank you all for joining us today. Looks like we did have one question come through. How early do you expect to start extending tax returns this year? Which one of you?
So we typically, it depends on what specifically you mean. So from our flow through tax returns, so partnerships and S corps, we actually as a firm believe that extending is the best option, regardless if you file on time or not. Typically because you have the ability to file a superseded return later on in the year if something changes or if you get an amended statement. So we typically in February start extending all of our flow through returns right up front. And in terms of from an individual perspective, it depends on the client situation again as well. From Maner's specific situation, we do actually have a just from a turnaround time perspective, I'm going to look to see, we have a date in March that if the firm doesn't receive the information by that time in March, it's typically 3-ish weeks before the deadline that we know that your return will be extended, just ultimately because we don't want to push something quickly out the door and not have it be able to be reviewed appropriately. And so we just extend a lot of those that come in after our internal deadline. I'm not sure if that exactly answers the questions.
All right. Thanks, Katie. Someone asked if the slides will be emailed to us. We are going to be sending out the webinar recording on Monday, November 21st, to all the attendees. So you guys can look out for that in your email. And there was another question on the ERC credit. Any word from the IRS on when they will start paying these again?
2029.
I'm sorry.
That's what it feels like though, right?
It does. I feel as though we still have clients that are receiving the credits currently. I don't know, Matt, have you heard anything different on that? I know that I personally have had clients that have been receiving them, have still been receiving payments. They are behind, obviously well behind. It's been a long time and will continue to be a long time. But I know that there was a long stretch that it seemed like nothing was being paid out. And then sometime this fall, it feels like I had a lot of clients who started receiving payments again.
Yeah, and I know I have clients that even from 2020 or that they've recently gotten refunds or they are still getting refunds. It's very hit and miss. And we mentioned already, trying to get a hold of the IRS is in itself a full-time job sometimes. So there's no exact timeline. I have heard, or I thought I saw, the IRS is actually starting to now audit some of the ERC claims too. So that's something to keep an eye out for.
Yes, and I was just going to mention on the ERC, we have had some luck in the event we get through to the IRS in called rattling the tree or shaking things loose. I'm not certain on if you are able to actually reach out and contact someone. It seems as though we've had some luck in then those credits actually being processed. That's not always the case by any means, and it is not an easy task to get through. But I know of at least a couple situations where it seemed that maybe we just got a lucky agent that time.
Okay, perfect. I think that wraps up the questions there. If anyone has any additional questions, Matt and Katie's contact information is on the screen and will also be in the email we send on Monday. Again, we will send out the recording and it will also be on YouTube. If you guys want to go back and watch it again. So I think that wraps it up. Thank you everyone for joining, and thanks again, Katie and Matt, for sharing your knowledge with us today.
Thank you. Thanks,
Thank you.
everybody. Take care.